I'm going to show you 4 ways to transform your trading almost overnight, and it's going to take me less than 10 minutes. I've made more than 30,000 from a single inefficiency, and I run over 10 automated trading strategies. Here's just one of my Hyperliquid wallets when I was exploiting a crypto inefficiency. Now, all of this is only possible because of trading. Without it, I would probably just be an accountant making just this in a whole year. But it definitely hasn't always been like this. For the first 2 years, I was stuck making mistakes over and over again, thinking, why am I still even pursuing this? Until I started to turn it around. Now, to help that transformation happen, hopefully a bit faster for you, or grow your trading even more if you're maybe coming from a discretionary angle, give me just 10 minutes and I'm going to show you 4 ways you could do it that were vital for my journey as well. Now, let me just make this camera a bit smaller so I can kind of zoom in for you guys. Just zoom in here a small bit. And let's get into the first one. So the first one is you'll need an edge before you'll be able to make any money. Before you can focus on the P&L you want and need, you need to be understanding why you should be making any P&L at all. What is your edge ultimately? Is it something that has been tested well over time, like trend following? Or maybe is it an arbitrage opportunity? When I first started trading, I was simply following patterns without understanding why they should actually work in the first place. I was really just thinking, well, support, resistance, take trade here, but ultimately there was no edge to that. It was just me purely guessing and gambling. Finding a real edge means understanding the market inefficiency or risk premium you're exploiting and why it exists. Now, if you want a video that goes a bit further into this, I have a video over here that goes over the 3 main types. But ultimately, what I'm trying to teach you with this first lesson is to actually make money in trading, you need to understand what you're exploiting and why you should be making money in the first place. I know that sounds incredibly simple and almost like common sense, but when a lot of people, and especially me when I was getting into trading, I really just thought it was because, I trade price action and that's how I make money. But ultimately, what you need in trading is an edge, and then psychology comes with it as well. But the first thing you want to lock down is, why should you be making money? Is it something like a risk premium? If you're unsure what a risk premium is, it's primarily where you're getting paid for the risk you're taking on above the risk-free rate, kind of like in simple terms. So for example, equities over a long enough horizon have always provided a higher ROI compared to something like bonds or high interest savings accounts. And why is that? Well, ultimately people are taking on more risk in the equities markets and they should ultimately be paid for that. Now that doesn't mean tomorrow they should get paid for it, but over a long enough horizon, that's why there's kind of like a premium in equities. Now the next one, let's just reveal this one here. The next one is testing rigorously, but don't force it. You will always want to backtest to confirm and test your ideas, and most importantly, actually understand the behavior of the particular strategy that you are testing. Now, what I am primarily referring to here is like, how long is your average drawdown? How many consecutive losses could you go into? What is your CAGR over a year? So what is your compound annual growth rate? Those sort of expectations will set you up very nicely, because without those, it can be very difficult to understand if your strategy is still working at the moment. And without backtesting it thoroughly and understanding these expectations and this behavior, then you can make more logical decisions using actual data of what you should be doing for your particular strategy. To give you a really simple example, just to kind of hone it in, let's say I backed this as a strategy and it was telling me that, hey, I could probably get into around a 30-day, 40-day max amount average drawdown for that X amount of time, right? So 40 days. If I then got into a drawdown for 60 days or 50 days, then I know that's very rare behavior and maybe something has actually stopped working in my particular strategy. Whereas if I was in drawdown for 10 days, then hey, that's probably not that big of a deal. Now, obviously you want to take into account the percentage of drawdown as well, but this was just one easy example. You want to be making sure to test across different market regimes, so bullish, bearish, choppy, etc. And you want to be using out-of-sample data. Now, out-of-sample data is when you are separating your data for backtesting to in-sample and out-of-sample. In-sample, you're optimizing over, and out-of-sample is ultimately what you're testing on to see if that particular strategy lives up on data it hasn't been optimized on. And this is a very crucial step. You could also implement something like walk-forward analysis, so walk-forward optimization is just a different version of out-of-sample data. And this can give you a much clearer picture of what to expect for results when you're actually running that particular strategy live. Remember though, you can't brute force a strategy to work by optimizing it. You will likely just overfit it. Now, overfitting is primarily when you're just heavily optimizing a strategy over historical data, making that the backtest looks amazing, but ultimately you've just fitted to noise on that particular historical data, kind of brute forcing it to look good in a sense, leaving you with a very pretty backtest and no live profits. Now, I actually did a tweet just recently about how I create robust trading strategies. I think it summarizes it up quite simply. Now, this isn't all the steps, but this should give you at least a really good starting premise. Now, ironically, you want to start with a very simple premise with logical reasoning. So what I'm saying here is that start with a core strategy type or inefficiency. So let's just say you're starting with a trend following strategy. We know trend following works. So you can look up a lot of papers around why trend following works. And ultimately, you can test it as well and see that trend following works. So I would start with something very simple like that. I would also keep a very low parameter count, so I don't have too many parameters likely to overfit the particular strategy. Then I would separate into in and out of sample data, like we've just previously mentioned. Then I would also measure the sensitivity of parameters. So what this is testing how sensitive your particular strategy is or parameters are to change and how that affects performance. So that could be in Sharpe ratio, that could be in net profits, etc. How you would do that is you would normally run a parameter sensitivity test using either a 3D surface graph or a heat map where you have each individual parameter value, and then you have the performance metric that you're gauging it by with the other X parameter value that you're testing against as well. And then lastly, you'd want to test through different regimes and stress periods. So a stress period could be like 2020, it could be 2008, etc. Those are great to understand how much allocation you should have to that particular strategy and if it can withstand any leverage, all those sort of things. Because during that stress periods is where you want to make sure that you survive. If your strategy works amazingly for 10 years and then it hits one stress period and it blows the whole thing up, well, ultimately none of it was really worth it. So you want to make sure that you can survive those particular stress periods. Now, the next one, if we delete this, is don't rely on one strategy alone. You want to build a portfolio. It will take time, but the risk-adjusted returns will be worth it, trust me. From my personal experience, building a portfolio was one of the biggest changes in actually building out my trading career. Now, when I was only trading one strategy, I could have months of 15% plus drawdowns. That would nearly make me quit. When you are having a strategy, especially when you're newer, and it goes into a 10, 20, maybe even 30% drawdown if you're trading something like in crypto, for example, those can be incredibly tough times to stay convicted to your strategy. And it's also difficult on your bank account. If you're trading full time, that's a very difficult thing to handle. So what we can do here to try and limit that is we can add counterparty strategies or uncorrelated approaches. So this could be mean reversion, this could be trend following if you're running mean reversion, for example, already, or it could be other strategies that will help smooth your equity curve dramatically. The greatest benefit isn't just obviously the diversification, it's what gives you the psychological strength to stick with trading during inevitable rough patches when any single approach is struggling. Now, what is the actual math behind this? How do we know this actually works? Well, it's referred to the Holy Grail, and it's actually coined by Ray Dalio and Jim Simons as well. And primarily what you can see here on the right-hand side is the annual portfolio standard deviation. So let's just say how much risk is getting taken on, so how much drawdown in simple terms. Then we have the number of assets in the portfolio. Now this can also be the number of alphas, or it could be the number of strategies in this case where I'm applying it to. Then on the right-hand side, you have the correlation of each one of these particular lines. So the correlation of those assets that are being put in that particular portfolio. So in this top line, there's a 60% correlation within the number of assets in that portfolio. And then we can see how it affects the overall risk or risk-adjusted returns on the left-hand side. So as you add more strategies here, you can see all the lines tend to decrease in the amount of risk or volatility in that particular portfolio, but they do flatten out, meaning that it's not, if you add 1,000 of these strategies, your returns between the 999 strategy to the 1,000 isn't going to be much of a difference at all to this particular volatility. But, adding your 1 to 5, you're getting the most amount of decrease in the amount of volatility on your particular equity curve, especially if you're dealing with something that's very low correlation. Now, that is hard to do because a lot of markets are very correlated nowadays, especially during stress events. But ultimately, this is why you want to build a portfolio of different strategies to try and reduce your volatility, which ultimately reduces your amount of drawdowns because either one of them are balancing them out. Now, the next one, if we quickly get through this, is simplify until it hurts. Make parameters fight for their lives. Every parameter you add creates opportunity for overfitting and reduces the likelihood your strategy will work in the future or on live data, which is what we actually want. I had a strategy with 12 parameters that looked amazing in backtests, but completely failed live and took me way too long to realize that I was overfitting it. Try focusing on 3 to 5 core parameters. Now, this may make it less impressive on paper, but it's going to make it a lot more robust in real trading. If adding a parameter doesn't dramatically improve performance, whether that be returns or reduced drawdowns, just leave it out. Now, here's how you can see that in a graph form. This is around prediction error and model complexity, but if you think about this as an inverted, so this could be Sharpe basically, and it's inverted, so the lower is better basically. You can see here how the more complexity you add, you kind of have this sweet spot where ultimately, if you add too much complexity, you are going to be overfitting and your training data is going to look amazing, but your tests, so actually running it live, is going to look really awful because you've overfitted the particular strategy. Now, obviously, if you really underfit the strategy, you're going to get the same result as overfitting. So there is a sort of sweet spot, but most of the time, it's a lot easier for people to overfit than underfit, at least from my experience. I've rarely seen people strip away so many parameters that it's completely underfit, unless, they're really going on the extreme to try and avoid overfitting. Now, if you want to steal the ways I implement these systematic approaches and many more, check out the first link in the description, but that's about time up.